The crash was the bait. On Friday, June 5, 2026, phones lit up worldwide as Bitcoin sliced under $60,000 and touched $59,100. Weeks earlier, it had traded above $80,000. By the next morning, it clawed back near $61,000. But the damage already felt permanent. Screens were red, traders were frozen, critics had their funeral speech ready. Yet behind the panic, something colder was happening. Roughly $1. $8 to $2. $5 billion in leveraged positions was being erased with brutal precision. Ordinary holders saw disaster. Large financial desks saw inventory. That was the split. The chart looked like a collapse, but the order books looked like a transfer of ownership. Because in Bitcoin, the most important question is not always why the price fell. The real question is, who is waiting underneath with open hands? Ignore the candles for a moment and look at leverage. Leverage is borrowed conviction. It lets traders control more Bitcoin than they can actually afford, and when the market rises, it feels like genius. But when the market drops, leverage turns a normal decline into a glass bridge. Every step starts to crack. When enough borrowed money stacks together, the market cannot breathe. It must force someone out before it can move higher. That is why the June plunge mattered. It did not just punish bad timing. It cleared unstable bets that had been leaning on Bitcoin's price like scaffolding. Once that scaffolding broke, the fall fed on itself. That was the trap. As frightened users hit sell, professional buyers stepped into the other side. They were not guessing. They were buying coins that panic had made cheaper. For the public, it felt like escape. For institutions, it was supply finally becoming available. And that supply did not appear by accident. The weakness did not begin on crypto exchanges. It began where global capital was rushing next. Artificial intelligence. By 2026, AI had become the market's brightest magnet. New AI companies were entering public markets through high-profile IPOs, and their valuations were enormous. Hedge funds and venture firms wanted positions before competitors did. But wanting a position is not enough. They needed cash immediately. They did not need a speech. They needed liquidity. So they turned to one of the fastest pools they could drain. Crypto became the cash drawer. Bit by bit, cash left Bitcoin and moved toward AI listings. On the surface, trading still looked alive. There were still candles, headlines, influencers, arguments, and noise. Underneath, the order books were thinning. A liquid market can absorb shocks. A shallow one cannot. Bitcoin had become a dry forest while everyone stared at the leaves. Algorithms do not need rumors when liquidity is thin. They only need a target. Most people believe strong markets rise smoothly. The best traders know the opposite. Markets survive through cycles of excess, fear, forced selling, and rebuilding. One tool used to read those cycles is the market value to realized value z-score, or MVRV z-score. Think of it as a valuation siren. When it overheats, Bitcoin may be expensive. When it falls below zero, history says panic may be hiding value. In major Bitcoin crashes in 2015, 2018, and 2022, the z-score dropped into negative territory. Headlines called the asset reckless, broken, and finished. But after every move below zero, Bitcoin later rose at least 300% in the next cycle. March 2020 showed the same psychology. Bitcoin lost roughly half its price within days as the pandemic froze the global economy. Yet over the following 180 days, long-term holder supply increased about 3 to 5 percentage points. That was not fear. That was accumulation. The clearest rehearsal happened in 2021. Bitcoin had climbed into the $60,000 range by spring. Then came mining ban fears, regulatory pressure, and forced liquidations. The price was cut in half and traded in the low $30,000. The public heard the familiar verdict again. Bitcoin was finished. Again. But larger players were watching a different structure. The Wyckoff accumulation phase. Named after Richard Wyckoff, the investor and founder of Magazine of Wall Street, It describes how major operators build positions quietly. They rarely buy everything at once. They pressure, wait, absorb, and let fear do the distribution. During that 2021 phase, whale wallets holding 1,000 BTC or more fell by about 12%. At the same time, smaller wallets increased as retail traders tried buying the dip. To the average viewer, the story looked terrifying. Big money was leaving. Retail was catching the falling knife. But the setup said something else. The surface was lying. Then May 19 arrived. In hours, $8.6 billion vanished through liquidations. That amount could buy the Dallas Cowboys outright and still leave roughly $3 billion. Stronger hands gained room. By late 2021, Bitcoin had surged again, and the supposed collapse looked different after the fact. It looked less like destruction and more like redistribution. Same movie, different victims. June 2026 looked almost identical. The headlines matched. The fear matched. The emotional pressure matched. But one thing had changed dramatically. In early 2024, the United States Securities and Exchange Commission approved the first Bitcoin exchange-traded funds. ETFs connected Bitcoin to the traditional financial system in a way that had never existed before. BlackRock, Fidelity, and other giants entered at scale. By the end of that year, institutions held about 900,000 BTC. That was roughly 4.6% of Bitcoin's circulating supply. It was only 200,000 BTC below the estimated 1.1 million coins linked to Satoshi Nakamoto, worth about $80 billion. That is gravity, and gravity changes the market. Before ETFs, Bitcoin crashes mostly lived inside crypto's own ecosystem. After ETFs, Bitcoin was tied to a much larger machine. Pensions, funds, allocators, portfolio managers, and giant institutions could now enter through a familiar wrapper. That made Bitcoin easier to buy. It also made Bitcoin easier to reposition. When the 2026 panic peaked, reports focused on $1.4 billion flowing out of spot ETFs. That sounded massive to anyone reading headlines. To mega funds, it was not the whole picture. Most institutional capital stayed locked in place. The largest holders did not run. They absorbed pressure while weaker holders sold into fear. That matters. Institutions do not trade like a person with an app. A retail trader buys, waits, panics, and sells. A giant fund needs scale without moving the price against itself. It cannot simply buy tens of thousands of coins in one visible sweep. That would ignite the market before the position was built, so it needs sellers. Not one seller. Thousands. This is where Bitcoin's scarcity becomes dangerous. Only 21 million coins can ever exist. No central bank can print more. No emergency vote can expand supply. And many coins are not realistically available at all. Some sit on lost hard drives. Some are locked behind forgotten passwords. Others remain untouched in cold storage for years. In 2024, Bitcoin's illiquid supply reached about 78%. That means only about 22% of mined Bitcoin was actually moving in open circulation. Imagine a city where nearly 80% of homes can never be sold. One wave of demand can make prices jump violently. So how do large buyers find supply? They wait for fear, or they help trigger it. This is the part most people never see. Market-making algorithms can estimate where stop-loss orders are clustered. When price approaches those zones, selling pressure can push it lower. The first stops fire automatically. Then more stops trigger below them. Holders are sold out before they can react. The chart falls. News spreads. Human panic finishes the job. At the bottom, coins flood the market at discounted prices. The same institutions that seemed absent can buy without chasing. Not emotional. That does not mean every crash is a guaranteed opportunity. It means the visible panic is rarely the full event. Some models still projected Bitcoin reaching $150,000 to $180,000 by the fourth quarter of 2026. Other models shifted as liquidity, leverage, and positioning changed. Markets are not destiny machines. They are systems of pressure, and pressure always reveals who is fragile. The lesson is simple and uncomfortable. If you use leverage, you can become the product. Not the customer, not the investor, the product. Your liquidation becomes someone else's entry. Your panic becomes someone else's patience. Your forced sale becomes someone else's long-term position. That is why the smartest players do not need perfect headlines. They need forced sellers. Bitcoin's history has shown repeated phases of hype, collapse, accumulation, and expansion. The names change, the fear changes, the trigger changes, but the structure keeps returning. First comes the excitement. Then comes the leverage. Then comes the shock. Then comes the selling that nobody wanted, but everyone overexposed must accept. And after the smoke clears, the coins have moved. Not randomly, not evenly. From weak hands to strong hands. From emotional hands to patient hands. From traders who needed the price to recover today, to buyers who could wait for the next cycle. That is why the June 2026 crash looked like the end. Fear always wears that costume. It arrives with red candles, brutal headlines, and confident people explaining why this time is different. But beneath the panic, the real story is quieter. Supply moves, ownership changes, power consolidates, and by the time the chart looks safe again, the best prices are already gone. The June 2026 crash was not just a fall in price. It was a test of who could hold while everyone else was forced to fold. In Bitcoin, panic does not destroy value. It decides who gets to own it.